Hello, hi. Jerry Miller here again from Trendsignal, the trader education company. We're just having a look at well, quite a busy week last week. So I want to just have a review of that first before I have a look at what's happening this week. So we had some key interest rate decisions out of the US, uh, long awaited, and also here in the UK, which sort of surprised some analysts really. And then we culminated last week with the release of the non-farm employment change. So two of the most important data releases of the month happened in the US in the space of a couple of days. Anyway, let's have a look at what happened. Um, in summary, I'd say that the Federal Reserve, that's the Federal Open Market Committee, along with its chairman, Jay Powell, I think they were surprisingly hawkish, really, about their sort of slant on interest rates, which suggests that interest rates will rise higher than the market had previously expected. Um, the rate setting committee, just to reiterate, I'm sure you're aware, they raised rates by 0.75%. That's the fourth such rise in four meetings. Forward interest rate contracts that are traded on the CME, the Chicago Mercantile Exchange, imply that interest rates won't peak now until the third or even the fourth quarter next year, and they're going to peak around 5 to 5.25%. So that's that's sort of been quite a negative move for the markets. All the US indices actually reacted poorly to the central bank news, with the Nasdaq eventually on the week closing down 5.6%, something like that, and that's its worst weekly performance since June. Sorry, July. Sorry, July. Do I mean July? No, I mean January. Gosh, no, January. But that's because we'd had a couple of really strong weeks preceding that, of sharp gains. So yeah, equities were weak, but I think that higher interest rate outlook tends to hurt the technology sector a little bit more, which is really sort of investing for future growth. And a lot of those companies don't have much in the way of earnings just yet. And the cost of those future earnings has gone up as interest rates have risen. It'll affect the broad market as well, of course, but the broad-based S&P 500, that also lost ground, but nothing like as much as the Nasdaq. S&P was down about 3.4% in the end. So an interesting time for the US markets, but in contrast to that, UK markets had a lot better week. I think the FTSE was ended up 287 points higher on the week. That's about 4%. The FTSE 250 also rallied, and it's on the back of, well, the Bank of England raised rates by 0.75% to 3%. So the headline was the biggest rise in interest rates for 30 years, which in fact that wasn't the main news really. The reason for the rally in the UK markets was due to the guidance that the bank gave. They've got a lot more sort of structured way of giving guidance in the US for the Federal Reserve, but in the UK, the MPC, it's not quite so clear. But Andrew Bailey basically said in a press conference after the meeting that interest rates were not going to rise as much as the market had been pricing in, and almost immediately interest rates. The prospects for a peak in interest rates fell. I think we'd been pricing in a rise to about 4.75% sometime next year, September next year, and that's been lowered to 4.6%. And I wouldn't be surprised if that comes down a little bit more still. So quite a split between the UK and the US. Here we are going to be suffering the consequences of a fairly prolonged recession. We, unfortunately, with a strong dollar, import a lot of inflation, especially with a lot of the energy. In fact, all of the energy that we import, obviously, is priced in dollars, along with other key commodities as well. So a strong dollar is not good for any economy, especially the likes of the UK, which imports a hell of a lot. Okay, let's have a look at the next section. So the revised interest rate outlook will have an effect on the markets, and one of the biggest effects that we've already seen is a fall in sterling. Sterling has fallen quite sharply. In fact, last week was probably the worst performing major against the dollar. On the week, it fell about 2.5 cents, whereas the euro was pretty much unchanged. Let's just have a look at one of those charts. So here you can see our chart on sterling versus the US dollar or cable on our platform charting center. You can see the day of the meeting last Thursday. Sterling fell quite dramatically from around 1380 all the way down to a low of one sort of 1150. It's recovered since then, but remember the dollar has actually been falling quite sharply across all majors since then anyway, especially on Friday when a couple of Fed members stated that they thought the Fed should be starting to slow the pace of interest rate rises, which was curious actually, curious at the time because the FMC committee, along with Jay Powell, had said that interest rates would still carry on at the pace that they were going, and it was quite a hawkish sort of comment. But Friday's contrast with these two members, one from Richmond and one for the Boston federal districts, that basically both said that they thought interest rates, the pace should slow. There we go. It's all part of a consensus, of course. Everyone has an opinion, and they have an opinion, but the committee for now is keeping that more hawkish tone amongst them. But you can see here this move in sterling. That's really down to expectations that interest rates are not going to have to go up as high as previously expected. How will that affect us? Everyday borrowings, mortgages, etc. A lot of those are dependent on gilt yields, and those markets actually, fortunately, have started to calm down quite a bit ever since Jeremy Hunt was appointed Chancellor, and ever since he's basically cancelled out all those mad tax cuts from Kwasi Kwarteng and the Truss administration. So it's possible that these mortgage rates may not be as high as some people feared, but there's been quite an acceleration in those mortgage rates because of the Kwarteng budget that probably would have happened, but over a longer period of time. So we're seeing the sort of reaction against that. So if anything, mortgage rates have sort of perhaps slipped maybe 30 or 40 basis points, but in the context of how far they'd gone in that period, they'd already gone up 200 basis points. So it's yeah, a little bit painful. Anyway, other than that, the week ahead, just very briefly, it's a very quiet week for data. We've got the midterm elections on Tuesday in the United States, where the whole of the lower chamber is up for grabs, or 435 seats or whatever, however many number it is. And it certainly looks like the Republicans are going to gain control of that, which won't be good. And the upper house, the Senate, is really on a knife edge. So I won't make any predictions, but the only prediction perhaps I will make is that if the Republicans do well, I'm pretty certain that Donald Trump will throw his hat in the ring for the 24 presidential elections. But that's America. That's I'm over here in the UK. I have no other comments to make on that. Other than that, we've got inflation data coming out, which is something that is worth looking at. Let me quickly open the browser, just show you. So the inflation data we're looking at is the headline reading and the core data. They're both very important. The one that the Federal Reserve tends to look at more these days is in fact the oops, let's close that down. We're more interested in the core reading. The core reading is one that is more how can I put it, endemic or built-in inflation. That's the one that the Federal Reserve will be most concerned about. And this is the core reading, plus 0.5%. In annual terms, this equates to probably a slight drop in the headline rate from 8 to 8% from 8.2%. And this data obviously is key to future rate rises. This number actually will be released again one day before the next Fed meeting on the 14th of December. So I've got a feeling that this one won't attract so much attention, but it will be interesting to see the direction of travel if indeed we do hit these expectations listed here. Obviously, equities, bonds, dollar, commodities will all be very sensitive to this release, so watch out for that. Other than that, there's a bank holiday on Friday in the US. It's Veterans Day, a celebration of, thank Armistice Day, as it were. I think it's a federal holiday there, so the markets will be shut. But there is some key data out on University of Michigan consumer sentiment, which is a great sort of reading of future positivity or negativity. If the consumer is feeling positive, then they go out and spend. If they spend, companies make more money. If they make more money, then market goes up, doesn't it? Yeah. But it has been on quite a horrible downtrend over the last year and a half, but ever since June, it seems to have bottomed out, albeit from quite a low base. But any improvement in consumer sentiment is positive for the markets. That's it. Thank you very much for listening and watching. All the best. Bye for now.